Long options trading using a stock substitute approach is a leveraged growth strategy. In this video, we'll cover the pros and cons of this approach so that you can make a decision about whether it is appropriate for you or not. Remember that in finance, the term long simply means you own something. If you're long a stock, you own the stock. If you're long the option, you own the option. The term long has nothing to do with time or distance. In this video, we're going to talk about a basic long option strategy known as the stock replacement strategy. We'll discuss how to build the trade, the mathematical principles guiding the trade structure, and how to manage the trade properly. Long options trading is not a high probability strategy due to all the variables that influence the value of the option. That doesn't mean that you should never trade long options. It just means that you should be aware of the different pricing influences on your strategy and be selective about when and how you choose to employ it. The first step in any strategy is to understand when to use it. The long option stock replacement strategy works best on stocks that you are extremely bullish on. To build the trade, you buy an in-the-money option with a delta somewhere between 70 and 80. It makes sense to also buy more time than you think you're going to need. For example, if you are bullish for a 60-day time frame, you may want to consider buying a 90-day option. The most you can lose in this trade is the money you spent to get in. The most you can make is theoretically unlimited for calls and limited on puts because a stock can't go below zero. The idea behind this approach is that you want an option that's going to behave similarly to the stock while still having plenty of leverage. At 80 deltas, the option is going to move 80 cents for the next dollar that the stock moves. As an added benefit, a high delta option has very little exposure to time decay and implied volatility fluctuations when compared to a lower delta option. The downside to this approach is that an 80 delta option, while significantly less expensive than owning the stock, is still going to be an expensive option. It also has less leverage than a lower delta option does. Let's compare two options with identical expirations as an illustration. In this example, the call with a strike closest to 80 deltas is the 177.5 call. It has a market price of $14.99 per share. The option I'm going to compare it to is the 190 strike that only has 52 deltas, and it's trading for $5.65 per share. The options expire on the same day, and the stock itself is trading for just over $190. The first thing most option novices tend to focus on is the cost of the option. At $14.99 per share, the 80 delta option is almost 3 times as much money as the 50 delta call. Well, focusing on the price alone, though, is the wrong way to approach investing. It'd be like buying a power tool based on price alone. You may get a cheaper tool, but it's probably cheap for a reason. You need to know why the 80 delta option is so much more than the 50 delta option, and then ask yourself, is it worth the extra cost? Well, let's do the math and find out why the 80 delta option costs more. As you can see, the 80 delta option has much more intrinsic value and much less extrinsic or time value. From a time premium perspective, the 50 delta option is almost twice as much money. Simply put, if you purchase the 50 delta option in this example, you're paying almost twice as much money for the exact same amount of time. You could use the option Greeks to do the same math. The 80 delta option represents a better value from a time decay and volatility perspective. When purchasing an option as a substitute for the stock, you probably don't want to be paying a lot of money for extrinsic value. Remember, the main motivation in this trade is to have an option that will follow the stock closely, but still provide a significant amount of leverage. Whenever you enter a trade, you should have an exit point already determined. Many option traders choose to use a percentage loss when setting exit parameters for a loss. For example, get out when the option's lost 50% of its value. Another technique would be to exit for a loss if a stock reaches a predetermined support or resistance level on a chart. Some traders might even be willing to just go all in and be willing to risk the entire amount paid. Whatever loss rule you use, stick to it. You can't afford to make exceptions or be inconsistent in your management technique. What about taking profits? Rolling an option for a profit is a great way to simultaneously control your risk and maintain the profit potential that a long option can provide. It's a technique to help you avoid emotional decision making. Rolling is just a fancy way of saying exit the position you're in and simultaneously open a new position with the same underlying security. When a stock moves in your favor, the delta on an in-the-money option normally increases. For example, you may have purchased an option when it had 80 deltas, but now that the stock has moved, it has 90 deltas. At that point, you probably have a pretty substantial profit on your long option. Let's look at an example using a real-world scenario. On this day, the stock closed at $114.02 per share. If you bought an option with a 6-month duration on that day, using this approach, you would have selected a 100-strike call because it had a delta close to 80. The market price for that call was $16.80 per share. By January 5th, that stock had moved to $118.86, and the call that you purchased for $16.80 is now trading for $20.40. That's over a 21% profit in about a week's time. Well, you'll notice that the delta of the call has also increased to 86. Let's forget about the profit for just a minute and think about the risk in your position. When you first initiated the trade, you had $16.80 per share at risk. Now you're risking $20.40. In this scenario, you should consider rolling to reduce your risk while simultaneously giving your profits a chance to keep running. You do that by selling the original call you purchased and buy the call with a delta around whatever your original delta was. In this case, you'd sell the 100-strike call for $20.40 and purchase the 105-strike call for $15.98. That's going to put $4.42 per share in your pocket, but you still have unlimited profit potential in the trade. In other words, you just reduced the original risk of your trade by over 26% while retaining unlimited profit potential. You can use this rolling technique to help remove the emotion from your trading. One of the biggest mistakes investors make is cutting their winners short. Since rolling allows you to reduce your risk, it also helps to reduce the emotional anxiety that can come along with profitable trades. Notice that in this example, we rolled to the same expiration date we originally had. At some point, if the trade is successful enough, you may need to roll out to buy more time. Normally, on a deep in-the-money option, you could stick with your original expiration date until you get within 2 to 3 weeks of expiration before rolling out and buying more time. As long as the stock keeps running in your favor, you can just keep rolling. Since you don't actually know the future, you don't know when the stock is going to stop running. Just keep rolling until the market forces you out by meeting your predetermined exit for a loss rule. As mentioned earlier, long options trading is not a high probability strategy due to all the variables that influence the value of the option. That doesn't mean you should never trade long options. It just means that you should be aware of the different pricing influences on your strategy and be selective about when and how you choose to employ it.